Hello and welcome to Livewire Markets. My name is Anna Dadic and today I'm joined by Andrew Swan, Head of Asia Equities ex-Japan from Man Group. Today he's going to be talking to us about investment opportunities across Asia. Hi Andrew, thanks for joining us.
Thanks for having me.
Given Asia's geographical distance from the US, how are President Trump's policy decisions impacting the region and how are you navigating it?
The US is the largest economy and largest trading partner for many parts of Asia. Naturally, the policy is impacting Asia. First and foremost, though, this is not new. We have been here before. Maybe it looks different this time around in some ways, but I think this has been anticipated both by governments and corporates to a degree. What I would say is what we're seeing at the moment is probably rather than concern on tariffs, it's the uncertainty and the volatility around will they, won't they, is pausing confidence generally, particularly in developed markets. We're seeing evidence of that uncertainty is starting to impact demand in the US. And as a trading partner, obviously that may flow through to Asia. But so far, I would say the US targets have been more allies per se, and we'll see how that policy evolves when it comes to places like China in the coming weeks and months.
Market concentration, valuation, inflation, rates, volatility, these are all big topics right now. How do these factors specifically impact Asia?
I would say the US market in particular has been very concentrated of late. Asia has been a bit more diversified, which is good. Some of the big companies from 4 years ago aren't as big today as they were, where we did have some concentration issues. There are some companies which have benefited a lot from, particularly in the semiconductor space, in recent years from the growth of artificial intelligence. When it comes to inflation, that is not an issue in Asia, but it is an issue when it comes to interest rate policy. And this is particularly important because we've had divergence in inflation between developed markets and emerging markets for the first time the last couple of years, and that meant divergence of interest rate policy. The challenge for central bankers in the region is that they tend to want to follow the Fed because if they go independent of the Fed, they tend to face currency challenges. This has been a very unusual cycle when it comes to interest rates because we haven't had inflation, but we've had high interest rates because central banks have been, even through to China, have been running US monetary policy effectively where there is high inflation into Asian markets. So we've almost had a de facto tightening of through monetary policy of financial conditions in the region, which is unusual. And it helps to explain partly why growth has been a bit slow in the region when the rest of the world's been pretty robust the last few years. Now, we are at a very important inflection point here. Perhaps the US has started to cut rates and maybe there's more rate cuts to come. That will support the region and we haven't had that tailwind for a while.
Andrew, you've shared a chart with us showing the US dollar inverted and the MSCI Asia ex-Japan index. Can you talk us through it and explain why it points to Asia's potential to outperform?
Yeah, look, it's a chart which shows you an inverse relationship between the dollar and Asia's relative performance, which is tried and tested through time, and it's always something we consider and we think about the US dollar and local currencies because it's extremely important. What you'll see in that chart is after many, many years of Asia's underperformance through a strong dollar, we're starting to see a weak dollar now emerge, which is kind of contrary to what I think most people thought after the US election. But nevertheless, the dollar has started to weaken. Good news for us is that means Asia is starting to outperform. Now, the reason this relationship holds is what it would tell you is the dollar historically has been a bit of a safe haven. So if the world is uncertain, investors tend to flock to safe havens, and the dollar is one of those. So in downturns, the dollar tends to be strong. And the problem is then central banks in the region need to keep their interest rates fairly tight with the US because they don't want their currencies to depreciate because it leads to capital flight, which tightens financial conditions. So a strong dollar is normally means tighter financial conditions in Asia, which weakens growth, and growth historically has been fairly high beta to the US. So if the US is slowing down and the dollar is strong, it tightens financial conditions even further in Asia, and it normally means Asia has a very tough time. Now, this is, again, a very unusual environment we're in because a weak dollar is coming on the back of weak US growth, but it's actually supportive of the region because it allows the central banks again to cut rates for the first time. So we're getting an easing of financial conditions potentially in Asia at a time when normally financial conditions would be tight. And that's why the outlook for the region's improving.
When you spoke to us last year, you were optimistic about a stable Chinese economy and supportive policies for equity markets. Since then, the Chinese equity market has moved higher, but it's hardly been a smooth ride. So coming with a two-prong approach, where do things stand now and how are you positioned? If we could start with the economy first.
I think more recently what we are seeing and what we have been talking about now for nearly 12 months is we do think we're at a very important inflection point in Chinese policy. Not so much short-term, but actually long-term in nature. And just this week we saw the State Council meeting really reiterating some very important messages about the long-term growth drivers for China. And quite simply, the model in China has been an investment-led economic growth model, and that's been supported by higher and higher levels of credit creation and debt. And the problem with an investment-led model is you create overcapacity and you get deflation that comes pretty regularly in China. And that continues to put risk on the system, similar to what you've seen in Japan the last 30 years. But what we saw this week, again, is critically important. The government is moving towards a policy which is focused on the consumer, and it's also focused on the demand side of the economy. If you think about command economy and you want to generate growth, you can only do the things you can control. So investment is easy to do. Putting credit in the system when you own the banks is easy to do. These are things in the control of the Chinese government. But what we've seen this week is a recognition that they need to create the right environment for demand to drive the economy through consumption. Now, this is, as I said, I think the market is underestimating just how important this moment in time is, because it is a long-term change in what drives China. We don't think it's a stimulus stuff which we're all used to. Is China going to stimulate the economy through credit? Those days are gone. What China is moving towards is creating the right environment for consumption to take over as a driver. And the way we see this playing out is the biggest opportunity China has is it has this extremely large savings pool. That savings over the last couple of decades has been used for investment, which has driven the growth model. But household deposits in the banking system are absolutely gigantic, and they've been rising rapidly even the last couple of years. So this one untapped asset that stands out there as a growth driver, and we do think the government understands that. Now, why is the savings rate so high? Well, there's many reasons, but one of those is that the social safety network in China is pretty poor relative to Western standards. A low spend by the government on social welfare. There's also household registrations, things like hukou, which sort of force people to save more because they're not getting the social welfare in the cities that they're residing rather than where they're born. And this has been the system that's been in place for many, many years. But if you look at the documents this week, they're talking about now focusing on elderly, childcare, pensions, insurance market. These are all part of that social safety net that the government is now looking to try and address, improve the quality, improve the quantity of. And by doing that, what they're basically saying is the households can now start to save less rather than continually saving more for a rainy day, because the government is starting to build that safety net around them. And the objective of this in our mind is to start to lower that savings rate and force that savings back into consumption. So this is a multi-year process. We're not expecting a big bang here, but I think this moment in time is extremely important. The market is sort of underestimating just really what's going on in China. It's a change in the growth model from investment, savings, credit to consumption and demand. And I think it's a very positive signal for the development of China and also the equity markets.
Okay, so covering the economy, so what about the stock market? What will drive returns from here?
Look, the starting point here is where the old economic model was at the end of its useful date, and the consequence of pushing it too far has been overcapacity and deflation. Deflation is bad for corporate profitability. It's hard for companies to grow profits. It's bad for employment. People have to cut employment, and so it's bad for income and consumption and the economy in general. So The starting point when this policy is now shifting is one where it's extremely challenged corporate profitability in China. And it's been going on for a number of years. And what we find is as earnings or company profits get revised down, which is what's been happening now for a number of years, the multiple on the market, the valuation multiple tends to contract at the same time. So the setup, last September when the policy started to pivot was extremely low earnings growth expectations and extremely low multiples. And we heard terms like China is uninvestable. We wouldn't say that. In fact, we were very positive on China at this time. So as the economic model pivots, and if this is successful, we still need to see a lot of the policy, but we're confident we're moving in the right direction here. This is effectively a shift away from deflation to reflation. Less supply, more demand means higher prices. And as you move from deflation to inflation, nominal GDP starts to rise faster than real GDP. And the last couple of years, it's been the opposite. And with that, corporate profitability can start to expand because companies can raise prices and people will start to see prices potentially rising in the future, so they'll consume today rather than waiting to consume in the future. So all of this is really good, I think, for corporate profitability. Now, corporate profits have stopped being revised down in China, partly because of the issues we talked about before. But what we do in our process and what we really believe drives markets is as earnings growth expectations or earnings are being revised up, the valuation multiple will start to expand. And actually, the market is very good at sniffing this before it happens. And so we do tend to see multiples expand before earnings revisions around these inflections in policy. And the policy is one for higher quality of growth and more sustainable growth. This year, we've seen China's been one of the best performing equity markets in the world. It's all PE expansion. There have been some companies getting earnings revised up and they're doing extremely well, but we're still early days in this process. I do think this is the outlook for corporate profit growth improves and the multiple in the market can expand from where it has been.
Well, Asia is a huge region and you've shared your thoughts on China and why you find it compelling. So what other markets in the continent do you like and why?
Yeah, as you say, it's not all China. And in fact, there's some nice idiosyncratic stories there. Some of the smaller markets like Indonesia and the Philippines, and when the Fed finally does cut rates, these are markets which will benefit from that process. Indonesia's having a pretty tough time at the moment, concerns on politics, but we think that will subside. And as the Fed cuts rates and the economy reflates there, that market looks very good for us. I think India is interesting now. We've been negative on India. We thought expectations got too high. And again, multiples got very high at a time when the economy needed to slow down, having had a number of years of very high growth. And the market has adjusted down lower now, and earnings growth expectations have also come down. So I think India is starting to look more interesting for the first time in a couple of years. And then within sectors, there's a lot going on as well. Obviously, tech is extremely important in the region. A lot of Asian companies make the things we use every day and the components that go into it and the assembly. And this first phase of artificial intelligence has been more about learning models and inference, which benefits semiconductor companies. But the next phase, I think, and this is the year, and we're already starting to see some signs of it, is the application of artificial intelligence into consumer devices, driving a new upgrade cycle. And there really hasn't been any new functionality in our phones for a long time now. Normally you just replace your phone because you've dropped it, as opposed to being attracted to something that looks cool and fun. I think that this is the year where we kind of get motivated to upgrade phones, tablets, iPads, even PCs potentially, as AI moves into these devices. And so we're starting to see some signs of that now. And there are a lot of companies in that tech supply chain in Asia. As I said, AI has benefited a few companies so far, but the next phase is there's a lot more companies. So look, it isn't just about China. There's many things going on. The region has underperformed for a long time. Corporate profit growth has been very lackluster. Fed policy, China slowdown, no tech cycle, all of these things are now changing. And as a result, the markets look pretty attractive to us.
Okay, Andrew, we've covered the big themes now, so let's get into your strategy. Which geographies and sectors are you leaning into right now?
Healthcare we like. I think there's some really interesting stuff going in the healthcare space. Again, the spend needs to increase, particularly in a place like China, to improve social welfare and safety nets. Indonesia we still like, Philippines we still like. So our preferences haven't really changed too much in the last 6 to 12 months, but I would say that the opportunity set is broadening from where we've been.
So when selecting companies for your portfolio, what are the top 2 or 3 qualities that you look for?
Look, we're very agnostic in terms of the type of company. What we believe and what we can have evidence of is that what really drives equity prices is changes in earnings growth expectations, or earnings expectations to be precise. In common terms, it's earnings surprise or earnings revisions. And there's a very high correlation between the change in the outlook for a company's earnings and the change in the multiple. So if company earnings, so consensus earnings forecasts are being revised up, you tend to see multiples expand. So you get the double benefit of higher earnings and higher multiple. And the flip side of that is when earnings are disappointing relative to expectations, you get multiple contraction. And so earnings revisions, we think the most important thing. So you can have a fantastic company that has seen great growth over a number of years, but as that growth starts to disappoint versus expectations, the stock can suffer. Most people are under or uninvested in the region, and there's been good reason. There's been no profit growth, 0 equity returns, and quite frankly, developed markets have done much better from a profit growth point of view, and obviously an equity market point of view. It's almost been 10 years since, apart from a couple little blips here and there, since the region has outperformed. But if we're right here with these multiple drivers, particularly led by China's inflection point, but also where we are in the tech cycle and where we are in the interest rate cycle, this is a region that can do extremely well because the starting point is very depressed, it's under-owned, expectations on earnings are low. Now is the time.
You lay a very compelling case, thank you. And thank you for sitting with Livewire today and chatting with us and sharing your insights.
Yeah, nice to see you and thank you for your time.
If you enjoyed that interview as much as I did, make sure to give it a like and subscribe to our YouTube channel where we release new content every week.